Good morning. It's Jeffrey Christian of CPM. It's 10:15 in the morning here on Tuesday, the 19th of August in New York. I want to talk a little bit about government borrowing and debt. We'll get to that first, but just to review the markets first. If we look at the gold price today, the spot price in New York is $3,334. It's a little bit lower than the London price, and the December active COMEX contract is $3,381. It's come off. It has not gone back up to test that 3,500. We think that is possible. I'm not quite sure when. That is going to depend on market sentiments. And part of my theme here is that the markets are waiting for the Jackson Hole Symposium that the Kansas City Federal Reserve Bank hosts every year in Jackson Hole, Wyoming. That symposium will be the 21st through the 23rd. Jerome Powell, the Fed chairman, and others will give speeches there. The markets are on hold, basically, hoping that the Fed will signal that it's going to have a September rate cut. It may or may not come. My own view personally is that interest rates probably should not be cut in September because we do have a lot of inflationary issues and we're seeing relative strength in the jobs market insofar as interest rates have an effect. There are some negatives in the jobs market, but they have more to do with immigrant workers being detained and taken out of factories, out of construction sites, out of farm sites, and causing disruptions in industrial production. Interest rate cuts won't help that. Interest rate cuts might exacerbate inflation. So my own view is that we probably should not cut interest rates at this point. But the markets clearly want that. There's about an 86% expectation in the FedWatch index on the CME group that the markets expect an interest rate cut in September. They'll be watching very closely to see what happens this week and what is said this week in Wyoming. In that environment, the gold price and other financial assets are kind of moving sideways. It'll be very important to watch to see how markets interpret what is said at the Fed, and we could see a sharp move in either direction as a result of that. You could easily see $3,400. And you could also easily see $3,300 or lower, $3,260. So market could move several $100s either direction based on what happens in Wyoming today. Silver prices, they're trading around $38. They have been trading around $38 for the last several days. Again, the markets are looking for directions and guidance as to what might be happening with interest rates and with the overall economy. Platinum prices also are trading sideways. They're at $1,356 this morning for the October contract on the NYMEX. Our expectation is that it could come down. I would not be surprised to see $1,130, $1,150 within the next few weeks. But part of that is going to depend on what the financial markets decide following Jackson Hole and some of the other economic data that's coming out. But our expectation is that the spike that we saw in June and July was temporary, that we've seen the first leg down in a move to go back toward where prices have been from 2014 until June of this year. And we wouldn't be surprised to see that happen beyond this week. And then palladium prices also coming off $1,141, largely unchanged from late last week, maybe up a few dollars. But again, we think that that price will probably normalize. It's already come back very close to the top of the range that we've seen since late 2023, which is around $1,100. Our expectation is that it goes back into that range and that we might even see $1,040 or even $1,000 over the next few weeks. September is an active contract, but we don't think that that's going to be a major factor. I wanted to talk, we got a comment or a question following one of our July presentations. And the person said, at what approximate level of government indebtedness does it start to affect businesses and corporations getting loans? In other words, the effect of national debt, federal debt, squeezing out private sector borrowing. It's a tough question, and it's interesting because one of the things I did in preparing to answer this question was to do a literature search. And what I found was that among economic experts and financial market experts, there didn't seem to be a definitive number that people used that they were willing to say, this is the number, this is the level of debt, this is the percentage of total debt, this is the percentage of GDP, at which national debt starts to squeeze out private borrowing. There's a lot of theories and discussions about the concept. Many economists consider it a theory of government indebtedness squeezing out private sector debt. They have some pretty good arguments in that effect. But it's an interesting idea. I'm not sure that there's a number, and I think that it's one of those things that you're going to know when you see it. This is total federal debt. It's about $36 trillion right now and rising. You can see that it started to accelerate in the early 1980s and it's accelerated further. It accelerated again after the financial crisis, great financial crisis in 2007 to 2011. And it's accelerated even further since 2020, 2021. It shot up in 2020 when governments shut down the economy. So it's $36 trillion. Now, you have to be careful. There's a fear of big numbers. Everett Dirksen from Illinois said back, I think in the 50s, maybe the 60s, a billion here and a billion there, and soon we're talking about real money in the government. It's easy to be overwhelmed with the concept of $37 trillion. But you have to understand that the economy overall has grown sharply too. And $37 trillion is problematic, at least in my mind, and in the minds of many people. But it's not necessarily unmanageably large because government's ability to generate revenue and pay down that debt is there. The government doesn't have the willpower to do it. Marginal changes in the marginal tax rate, marginal changes in the Social Security regulations would solve the Social Security issue, which is not in the federal debt. Marginal changes in the tax rate and in defense spending and in other factors could actually reduce the deficit spending sharply and possibly even get us to a point where we could pay down that debt. But the political will is not there either on the part of the voters nor on the part of the government. So it's $37 trillion. If you look at that as a percent change year over year in the federal debt, it has been growing and it's been growing sharply. And, the normative level post-COVID has been in that 5 to 10% per annum increase in debt per year. It's very problematic. And it's higher than the 2.5 to 7.5% that we saw in that period from 2014 to 2019, after the global financial crisis and the Great Recession, but before the COVID lockdown. and it's higher than it was in the distant past. But the third factor is federal debt as a percentage of U.S. GDP, and you can see it is at the highest level it's been at really since 1947. In 1947, U.S. debt, federal debt as a percentage of GDP was around 120%. But federal debt in total was it was like $500 billion. The government and the economy were much smaller back then. We had a very high percentage of GDP represented by government debt, given the World War II spending, the post-World War II recession in 1947 did not help. And we paid that down from 1947 into the early 1980s. The Reagan tax cuts and the Reagan deficit spending, taking the deficits from like $58 billion in 1978-79 to $300 billion within a few years, did not help the debt. And it started to boost that debt, and we've seen it rising pretty much ever since then. There were 4 years where we actually reduced the debt in the late 1990s. But that was reversed after 2001, and it's just gotten worse and worse. Now, the question is, at what level does federal government debt and spending and deficit spending squeeze out private sector debt? And there's no definitive number there. It's hard to say what it is. $36 trillion is a frightening number, but the reality is that the economy is large enough that it is continuing to do that. The problem is that part of the strength in the economy has been government spending, and government spending on a deficit basis. And those deficits are scheduled to get even bigger, which will increase the debt even more, which will apply upward pressure on interest rates. Whether or not that upward pressure on interest rates squeezes out, let me rephrase that. The extent to which that upward pressure on interest rates squeezes out private sector borrowing, both from corporations and from private consumers, is an issue that doesn't have a definitive numerical answer. Now, if you go back to 1980, we had like 11% mortgages, but people were still buying houses, 1981. And we had very high interest rates from 1980, 81 into 1993, 1994. Treasury bills and bond rates came off after really 1992. And that period of time saw very strong economic growth, partly because of deregulation, partly because of globalization, partly because of computerized assistance in manufacturing and in other factors. We had a very strong economy, even as government debt was rising and rising sharply, rising as a percentage of GDP, and ostensibly threatening to squeeze out private debt. So I hate to say it, but I don't think that there is a concrete number. It's sort of like we'll know it when we see it. It's not here now. We have to sort of see where we're going over the next couple of years in terms of government deficit spending and the upward pressure on interest rates. The government clearly right now, the administration is trying to gut the independence of the Fed, which would be catastrophic for the U.S. economy as well as the U.S. financial markets and for consumers and for corporations. That independence is very important. That independence would keep interest rates much higher than the politicians would like it to be, but it would also allow us to continue to operate as a going concern economically as a nation in the face of mounting deficits and debt. So it's very scary. There are a lot of problems that are out there, and that's being reflected in increased demand for gold and silver from investors. But there's just no definitive number there. Sorry, I can't say, at this level of debt, at this level of interest rates, we start to see private borrowing negatively affected by government debt. I will say this, in preparing for this, I wrote a note to myself, and what I said was government borrowing squeezes out private borrowing from 0% onward. It always has a negative effect. The question is, at what level does it become really problematic? And at what level does it actually start to significantly reduce economic growth because the borrowing costs or the ability to find money disappears. Now, we saw that in the period 2009 through 2019. And you can see right here, federal debt as a percentage of GDP was rising relatively slowly compared to what came after that. I'm sorry, it's up here. We saw the debt rising as a percentage of GDP, but then it plateaued, right? And you saw that the debt levels were negatively affecting the availability of credit to corporations and people, especially small and medium-sized enterprises, were having trouble finding money to borrow, let alone pay a given interest rate. Interest rates were very low at the time. Large corporations and the government could borrow all they wanted, and it was obscene the level of risk that lenders were willing to extend to corporations that probably shouldn't have had that kind of credit availability. But if they were large enough, they could borrow everything they wanted at extremely low rates. But small and medium-sized businesses from 2009 to 2019 were squeezed in that they couldn't get lenders to give them money, to lend them money, even at higher interest rates. That could happen again. What level it takes to happen is not clear. Part of it is that it's not just the level, it's the rate of change and the direction of the change. Other factors determine interest rates as well as government and credit availability. You can see here that rate of change is and can be very important to whether or not corporations can borrow, even in the face of enormous federal deficit spending. That's all I have for now. You can go to our website, buy our gold, silver, platinum yearbooks, get some free reads, see what other services we have, and you can write to us at info@cpmgroup.com if you want to talk about ways that we can help you better manage your exposure to precious metals and commodities. Take care. Take care of yourselves. Take care of those around you. Do something good for the world, and we'll talk to you on Friday.